Whenever things are doing well, we create some type of narrative around it. I've got to get into this asset. And we see this a lot even with our clients. When something's doing well, it's like, oh, we need to be in that. Usually that's right towards the end of some type of move. Bitcoin's a good example. When Bitcoin's doing really well, we get phone calls. Everybody's like, oh, I need to put 20% of my portfolio into Bitcoin. And then when it falls 20%, it's like we don't get any phone calls. But this is the one mistake that investors of all ages, and it's more detrimental the older you are to chase returns than it is when you're younger. You can get away with chasing returns when you're younger, but you actually pay a much bigger penalty than you expect. This is the one thing that we don't think about. The financial media is really good about selling you products, and then they tell you, for instance, like, oh, just buy an ETF, passive index, and you'll get growth of the markets over time. It's not bad advice if you're young. You're going to get average returns over time, but the true trick to investing is buying things that nobody else wants and sell them when everybody else wants them. And this is the one challenge that most investors get wrong, is because when things are running, we all buy the things that are going up, and we don't want to own the things that nobody wants. Like, for instance, nobody wants utility stocks right now. They're very cheap. Fundamentally, they're cheap. Price-wise, they're cheap. Technically, they're cheap. Nobody wants them because they're not performing. It's like, why would I buy that when I can buy this over here? AI stocks have been under pressure lately. A lot of those companies are getting pretty cheap. Nobody wants them right now because we're chasing industrials and materials. Eventually, that's going to change, and where we want to be positioned is when that rotation occurs, we want to catch that rotation as it happens.
Markets or investors being a little complacent. I get that sense right now from a lot of the conversations that I'm having with prospective clients, where everything seems very easy right now. I think there's a group of investors out there that are getting lulled into return expectations that are just not the norm. I mean, they're looking at things like silver ETF, SLV. You look at that last year, it was up 145%. So if that's not in a portfolio, it's like, why don't I own that? As investors, I think we, rather than focusing on our portfolio as a whole, what I call the forest, we start nitpicking at the trees, and we let that one tree right there dictate how we feel about our overall situation or how our portfolio is doing overall. We look at these areas of the market where returns are doubling, and we somewhat expect certain positions in my portfolio to double every year. And that's just not the norm. But we get so focused in on that one, it's called framing, where you focus in on one investment and you let that really drive your feel of success, and it can really lead you to make some knee-jerk reactions that longer term can be very detrimental.
Catch me daily on The Real Investment Show. The link is in the description.